Hey guys, what is up? Welcome back to my channel. In last week's video, we talked about how to invest in stocks in 2020, and in today's video, I'd like to build up from that video and talk about moving average strategy and how to use moving averages. So check out this video if you haven't already watched it yet. So moving averages is one of the most powerful and commonly used technical indicator by traders. So some investors even use moving averages when they are making their investing decisions. So moving averages are therefore used by both traders and investors alike. So in today's video, I'll be going through what moving averages are, how to use them, and my 3 moving average trading strategies. So make sure you watch the whole video because I'll be revealing these 3 secret moving average trading strategies to you. Okay, let's dive right in. Now that I'm on my screen, let's start. So we are going to take a look at the definition of moving averages. A moving average takes the average of prices over a specific period of time and smooths out short-term price fluctuations. So for example, a 10-day moving average takes prices from the most recent 10 days and taking that average and then plotting it in a line on our price charts. So depending on the individual investor and trader's configuration, the moving average can be a 5-day moving average, 10-day moving average, 50-day moving average, and so on. So since moving averages are based on past prices, it is a lagging indicator. This means that if we compare a 10-day moving average and a 200-day moving average, the 200-day moving average will have greater lag because it contains prices for the past 200 days, whereas the 10-day moving average contains prices for the most recent 10 days. So that's the first thing to take note, that longer term moving averages have greater lag than shorter term moving averages. So while there are less fluctuations and volatility in a longer term moving average as compared to a shorter term moving average, the longer term moving average also responds slower to price and trend changes, which means that it has a greater degree of lag compared to the shorter term moving average. So there is then a trade-off between using a longer term moving average and a shorter term moving average. So on the one hand, a longer term moving average is less likely to give false signals and have less volatility compared to a shorter term moving average. But on the other hand, a longer term moving average is also slower in picking up price and trend changes. So this serves to highlight that there is no holy grail or best technical indicator out there. So what we as investors and traders need to do then is to find the technical indicators that serve us best and use them. So what do I mean by that? There are 2 types of moving averages, the longer term moving average and the shorter term moving average. So some of you might be wondering then, so Linus, now that we have known about longer term moving averages and shorter term moving averages, what moving averages are considered long-term and what moving averages are considered short-term? So the term longer-term moving average and shorter-term moving averages are all relative in nature. So let me explain. A short-term trader may consider a 10-day moving average a longer-term moving average because he or she is using a 5 and 10-day moving average. So when using these 2 moving averages, the short-term trader will consider that the 10-day moving average as a longer term moving average. So a longer term investor, however, may consider a 10-day moving average a shorter term moving average because he or she is using the 10-day moving average and the 50-day moving average. So again, if the investor compares the 2 moving averages, he or she will consider the 10-day moving average as a shorter term moving average because it is relative to the 50-day moving average. So there is no fixed definition of what constitutes a short-term moving average and what constitutes a longer-term moving average. However, as a general rule of thumb, the 150 and 200-day moving averages are most often used as a longer-term moving average. So moving averages below the 150 moving average are then subjective to the other moving averages that the individual investor and trader use. So on top of short and long-term moving averages, there are also simple and exponential moving averages. So a simple moving average is taking the recent closing prices and then simply dividing that by the number of days that prices were used. So a 10-day moving average is calculated simply by adding the closing prices of the past 10 days and then dividing it by 10. And a 50-day moving average means taking the closing prices of the past 50 days and dividing it by 50 and so on. An exponential moving average, on the other hand, is a weighted moving average that gives more weight and importance to recent prices than the simple moving average. So the EMA, or exponential moving average, responds more quickly to price changes than a simple moving average. So that's the upside of using the EMA. The downside is then that the EMA, or the exponential moving average, is more prone to false signals and price fluctuations. So before we take a look at my 3 moving average trading strategies, I'm going to give you a quick overview of trends. So understanding what trends are will give greater context to the strategies that I will share with you later on. So there are 3 main types of trends in the market: uptrend, downtrend, and consolidation, or in the range. So uptrend is when prices are generally rising over time, so making higher lows and higher highs along the way. So downtrend is when prices are falling over time and making lower highs and lower lows. And consolidation, or in the range, is when prices are moving sideways. So as investors and traders, when we buy, we want to buy when the market and stock is on an uptrend and sell when the market and stock is on a downtrend. So that's a quick overview of the 3 trends in the market. So now that we know the definition of the moving average, the different types of moving averages, and the 3 different types of trends in the market, the next thing is, how do we use moving averages when we are investing or trading? I'll be revealing the 3 moving average strategies that I use when I invest and trade. So the first strategy I use is to use the slope of the moving average to help me indicate the trend of the market. So using the slope of the moving average, an uptrend is indicated when the moving average slopes up, and when the moving averages are sloping down, then the stock is on a downtrend. So let's take a look at some examples to see this strategy on our price charts. Okay, so for this example, it's the Amazon stock. So for Amazon stock, and on this screenshot, can you tell whether the stock is on an uptrend, a downtrend, or consolidation? Yeah, so the stock is on an uptrend because we can see that the stock is making higher lows and that prices have been increasing over time generally, right? So if this stock is on an uptrend, just by looking at the candlesticks making higher highs and higher lows, can we use the moving averages to tell whether the stock is on an uptrend or downtrend or consolidation? We can, right? Because we learned in the first trading strategy that the moving averages, the slope of the moving averages, tells us whether the stock is on an uptrend, downtrend, or consolidation. So in this case, you can see the red line and the blue line are the moving averages. The moving averages are generally sloping upwards. So if the moving averages are generally sloping upwards, what does that indicate to us? It indicates to us that the stock is on an uptrend. So we can see that here the moving averages are sloping up, and when the moment prices start to fall a bit for a while, you can see that the moving averages also start to reverse and slope down. And then when prices start to increase again, can you see what happened to the moving averages? The moving averages start to slope back up. So that is one way to use moving averages. So for this example, another example is also the stock for Amazon. So can you see on this price chart that when prices are declining over time, look what happened to the moving averages. The moving averages also are sloping downwards. And then when prices reach the bottom and start to increase for a while and then move sideways, what happens to the moving averages? So from when the moving averages are sloping down, right? And when prices start to increase, look what happened to the moving averages. The moving averages start to slope up. And then for this period, you can see that prices are kind of moving sideways. So when prices are moving sideways, look what happened to the moving averages. The moving averages also tend to even out and go in a straight line. So the slope starts to even out and goes to a straight line. So that is another way to look at the moving averages. So let's take a look at another example. So in this case, this is the price chart for Alphabet or Google. So as you can see on this price chart, prices are generally increasing, right? So can you see that when prices are increasing, the moving averages are sloping up, right? And then here you can see that prices start to decline for a while. So when prices start to decline for a while, you can see that the moving averages from sloping up, it sloped down, or like it break even for a while. And then when prices continue its rise back, then you see the moving averages slope up. So that's the first way we can use moving averages. So the first way we use moving averages is to see the slope of the moving averages and to use them to indicate to us the trend of the market and the stock. So the first moving average strategy is to use the slope of the moving average to indicate to us the trend of the market. So the second strategy is the moving average crossover strategy. So the moving average crossover strategy is when a shorter term moving average crosses above a longer term moving average. This indicates to us an uptrend. So when a longer term moving average crosses above a shorter term moving average, this then indicates to us a downtrend. So in an uptrend, we want to see that the shorter term moving average above the longer term moving average, and in a downtrend, we want to see the longer term moving average above the shorter term moving average. So let's take a look at some examples and see how we can use these strategies on our price charts. For this example is an example of the SPDR, which is the US ETF or the SPY. So in this example, the red line or the red moving average is the 20 moving average and the blue line is the 40 moving average. So can you see that when prices start to decline, the red line, which is the 20 moving average, starts to cross below the blue line, which is the 40 moving average. So what does this indicate to us? When a shorter term moving average crosses below a longer term moving average, this indicates to us that it's on a downtrend, right? So this downtrend is also reflected in the prices making lower highs and lower lows. So after prices decline for a while, and you can see that prices start to decline for a while, and then it starts to make its increase and rise over time, right? So what happened when prices start to rise? Can you see that the red line, which is the 20 moving average and the shorter term moving average, starts to cross over and above the 40 moving average, which is the longer term moving average? Can you see that? So once this crossover happens, this indicates to us that the trend is on an uptrend. So we can see that on this uptrend, prices make its way up and increase over time. So as you can see, prices here were moving sideways. Another thing to take note, when prices are moving sideways or in a consolidation, the moving averages don't work as well. When prices are in a consolidation, the moving averages tends to be like haywire, if you can say that. So I don't really use moving averages when prices are trading sideways or in a consolidation. So the moving averages I found to work best and are most accurate when prices are on a clear uptrend or a clear downtrend. So here you can see that prices make a huge drop. So we can see that the downtrend is quite clear in this case. So when the downtrend is quite clear in this case, we can use the moving averages to help us indicate the trend. So can you see that when prices start to make a huge drop, look what happened to the shorter term moving average. The shorter term moving average start to cross below the longer term moving average. So this indicates to us a downtrend. Okay, so let's take a look at another example. Okay, so for the next example, we are also looking at the SPY again. So can you see that when prices are decreasing, look what happened to the red line. The red line is the 20 moving average. And the blue line is the 40 moving average. So the red line is the shorter term moving average and the blue line is the longer term moving average. So when prices are declining, can you see that the shorter term moving average is below the longer term moving average? And when prices start to rise, look what happened to the moving average. The moving average starts to slope up, right? So the sloping up is back to what we learned in the first moving average trading strategy, that when prices move up, the moving average also tends to slope up. So in this case, can you see that when prices are increasing and rising, the moving average starts to slope up a bit. But before the shorter term moving average could cross over the longer term moving average, prices start to decline. So when prices start to decline, immediately the shorter term moving average starts to stay at its position and be below the longer term moving average. So it stays below, and then when prices start to increase and rise for a while, look what happened to the moving average. The shorter term moving average starts to slope up and cross over the longer term moving average. And you see, after a while, prices start to decline. So when prices start to decline, look what happened to the shorter term moving average. The shorter term moving average starts to slope down and crosses below the longer term moving average. And then here again, you see prices starts to rise a bit, and look what happened to the shorter term moving average. The shorter term moving average starts to slope up a bit, and before prices could continue to rise, it moves sideways for a while, and after that it declines. So the moving average, the shorter term moving average, couldn't cross above the longer term moving average. So you can see that prices continue to decline. So when prices continue to decline, look what happened to the shorter term moving average. The shorter term moving average is still below the longer term moving average. And that is how we use the moving averages. When a shorter term moving average is below a longer term moving average, this indicates to us a downtrend and that prices are declining in general. And if a shorter term moving average is above a longer term moving average, this indicates to us a uptrend and that prices are increasing in general. Okay, so let's take a look at another example. So this is applied materials. Okay, so here you see that prices are rising. So when prices are rising, look at the red line. So the red line is the 20 moving average. So the shorter term moving average is above the longer term moving average. So this indicates to us that it's on an uptrend and prices are increasing. So look at the moment when prices start to decline. Look what happened to the moving average. The moving average starts to slope down first and then cross below the longer term moving average. But then prices rise for a while. So you see that the shorter term moving average also starts to slope up. But before it could slope up all the way, prices start to decline. So when prices start to decline, the moving average also slope down, and then the shorter term moving average will stay below the longer term moving average. So as you can see here, prices are generally decreasing. So when prices are generally decreasing, look what happened to the shorter term moving average. The shorter term moving average tend to stay below the longer term moving average. So you can see the moment prices hit the bottom and starts to rise, look what happened to the moving average. The moving average lag a bit because as we mentioned earlier, moving average just take past prices, therefore it's a lagging indicator. So can you see that when prices start to increase, the moving average lag by a bit, but after you increase for a while, then the moving average start to pick up the change in the trend. And when it picks up the change in the trend, what does this mean? It shows us that when the moment the shorter term moving average crosses above the longer term moving average, this is a moving average crossover strategy. And when the shorter term moving average is above the longer term moving average, prices are on an uptrend and prices are likely to increase over time. So that is the second moving average trading strategy. So the second moving average trading strategy is the moving average crossover strategy. So specifically, when a shorter term moving average is above a longer term moving average, it indicates to us an uptrend. And when the longer term moving average is above the shorter term moving average, it indicates to us a downtrend. The third moving average strategy is using the gradient of the slope of the moving average. So in an uptrend, we ideally want to see our shorter term moving average with a steeper slope compared to our longer term moving average over time. So this will mean that our shorter term moving average is diverging away from our longer term moving average. So this moving average strategy indicates to us that there is momentum in our uptrend and that prices are likely to continue to rise over time. So let's take a look at some examples to see how we can use this strategy on our price charts. Okay, so this is another example. So this is the builder's first source. So we can see that when prices start to increase, can you see the shorter term moving average, which is the red line, crosses above the longer term moving average. So that is what we have learned in the moving average trading strategy number 2. So the second moving average strategy that we learned was the crossover strategy. So we learned that when the shorter term moving average crosses above the longer term moving average, it indicates to us an uptrend. So can you see that when the moment prices increase and starts to gain momentum, look what happened to the slope of the shorter term moving average. The slope starts to diverge, or the shorter term moving average starts to diverge away from the longer term moving average. And it increased for a while, prices increased for a while, and look what happened when prices start to decrease. The slope of the moving averages from the slope which is sloping upwards starts to slope downwards. So that is the first strategy that we learned in our lesson early on. So the first strategy is that when the slope of the moving average is sloping up, it generally indicates to us an uptrend. And when the slope is sloping down, it generally indicates to us a downtrend, or that prices are declining. So can you see that when prices are declining, look at the slope of the moving average, it starts to slope down, and it slopes up a bit because here prices start to rise. And when prices start to fall, it slopes down until the shorter term moving average crosses below the longer term moving average. So this shows us that prices have been declining for a while. But the moment you see when prices start to rise, look what happened. The shorter term moving average starts to cross above and back up from the longer term moving average. And you can see that prices here have some momentum. So we see that the shorter term moving average starts to diverge away from the longer term moving average. So that's how we use the moving averages in our price charts. That's the 3 moving average strategies that you now know and can use in your investing and trading. So to recap, the first strategy is to use the slope of the moving average to help us indicate the trend of the market. So a moving average that slopes up can indicate to us that it is on an uptrend, and a downward sloping moving average can indicate to us that it is on a downtrend. So the second strategy is the moving average crossover strategy. So we want to see the shorter term moving average crossing over and above the longer term moving average in an uptrend. And in a downtrend, the longer term moving average crossing above the shorter term moving average. And the last strategy is that we ideally want to see our shorter term moving average to have a steeper slope than our longer term moving average in an uptrend. So this will indicate to us that there's momentum behind the uptrend. That's the 3 moving average trading strategies. In this video, we have learned the definition of a moving average, the different types of moving averages, both the shorter term and longer term moving average, and the simple and exponential moving average. Next, we learn about the 3 types of trend: the uptrend, downtrend, and consolidation. And finally, we learn about the 3 moving average trading strategies. So let me know in the comments below what are some of your takeaways from this video. If you have liked this video, give us a thumbs up and subscribe to my channel, because I will continue to post one new investing and trading video every week. So subscribe and turn on the notification bell so that you don't miss out on these videos when I release them. So I'll see you in the other videos. To your financial success.